Hi everybody, this is Alan from Alpus Group, and I'm just going to talk you through a calculation that we've done on a particular commercial to residential conversion site. This one is actually in Colchester, is a real example, and just explain to you the process that we go through in order to evaluate what the gross development value of the site could be after conversion, and the refurbishment and associated legal costs, stamp duty, design costs, finance costs, contingency, budget allocation. So what we do is we start off with locating the site on Nimbus maps, and we get an exact address and an exact postcode. From the Nimbus maps information, we can identify the owner of the site, we can identify whether it's an individual or a company, and we can also look at what other portfolio properties that company may have. As it happens, this particular one didn't have other associated properties with that company. It's just a one-off purchase. The asking price for the site is 950,000, and what we want to see is whether we can actually make that work at that figure. So what we did was we ran some calculations using property data, which is another software package that we use, and the property data calculation came up that if we used 900 or 950,000 for the purchase price for the site, that we would actually lose money or potentially just break even. So what we've done is we've calculated back, and we've come to a purchase price for the site which would give the sort of profit margin that we would require. This is profit and risk margin because there's a lot of uncertainty about construction costs, inflation and so on at the moment, and what we want to make sure is that in our budget for the site we've allocated sufficient for each category. So if we look line by line through this calculation, we look at a purchase price of 750,000 for the site. We haven't yet negotiated and seen whether that would be acceptable to the seller, but that this is the sort of price we would have to pay for it to be viable for us. So if we were to have our offer accepted, the stamp duty on that amount would be £50,000. The legal costs would be around £5,000, and that's only for the purchase. So we need to bear in mind that the legal costs for the sales must come out of profit. So if we just bear in mind that we've got 14 flats at say £2,500 each plus VAT, that's a significant chunk of money's got to come out of the profit for the legal cost for selling on the converted flats. Architects and consultants fees, so that includes architects, civil, structural, electrical, mechanical, heating and ventilating, and any other specialist surveys, topographical surveys that may be needed, plus project management. We've allowed 11%, which is not excessive if there are particular problems with the site that could lead to some specialists being required. One thing that might come to mind is asbestos removal, and all of a sudden you've got a massive chunk of money and time which is needed to clear asbestos from the building, and this would need to be allowed. It's not allowed specifically in our figures here, so it would have to come from contingency, which we've allowed as 10% of the subtotal of the construction and design and legal costs. So refurbishment costs, there are 9,500 square feet of refurbishment at £87 a square foot plus VAT. This is the property data figure for average standard construction. Now, property data gives you 5 possible categories ranging from very low quality to very high quality finishes, and we've taken the one in the middle, which is the average standard. So if we took higher standard, then the costs would go up £100 a square foot, maybe more. So we should perhaps rerun the figures with a higher cost per square foot, i.e. a higher specification, and see just what sensitivity there is to the profit margin by doing that. The other variable is that if we increase the quality standard, then the selling price should increase as well. So we should do a range of figures from the lowest to the highest, but just for simplicity on this video, we've just taken the average standard. So we subtotal the purchase price 750,000, the stamp duty 50,000, the legals 5,000, architects and consultants fees 108,000. That of course includes local authority fees as well. Refurbishments 9,500 square feet comes to £986,000. So that's 1.899 million as a subtotal of costs as we assess it at the moment. We allow 10% for contingency. This is a minimum that we would allow at this stage because we've got no design, we've just got very rough costs, and what we don't want to be doing is omitting the contingency or making it a ridiculously low amount, so that as soon as we get any problem, like I mentioned about asbestos removal, that there's suddenly insufficient money in contingency to deal with it. And then the finance costs, and we've allocated 10% to the subtotal of finance costs. This assumes that we can get in and out and carry out this commercial to residential conversion within a year using permitted development rights. This doesn't allow for a protracted period of planning submissions and so on. So it's a permitted development approach that we're going to take, which is low risk. That gives total costs, including the contingency and finance, of 2.278800 million. We look at the average asking price in the area, and we've taken this from Nimbus Maps again. We did look at the property data figure, which was slightly lower. It was £293 a square foot. So we think, based on the Nimbus Maps assessment and also some verification that we've done from Rightmove, that £325 is probably a reasonable sort of asking price for a newly converted flat. So the total potential value is 3.087500, giving a potential profit margin of 808,700, which is a margin of 35.4%. So we'd be looking for at least a 33% margin. Bearing in mind what I mentioned about asbestos, we've made no specific contingency allowance for that. What we'd be looking to try to do is negotiate the purchase of this price around about £750,000. The vendor is looking for nearer £1 million, and maybe our bid won't succeed. But what we don't want to do is end up paying too much for the site and then ending up with either no margin on the project, or a small margin, or even a small loss. You just don't know in this volatile period when construction costs are still rising, and we haven't got designs, so we haven't got a clear idea of what our specification is. We've taken a rough approximation for this calculation to come up with a ballpark figure for the value of the site. So I hope that's been of some help. We'll do some other examples, and we'll show you more case studies of how we calculate site values from potential gross development values This is why it's always better to get a property transformation from low to high value in a generally higher value area, higher residential value area, rather than a low value area. Anyway, that's all for this case study. Cheers for now.